would say that is more of a bigger picture view is that a lot of people in the financial sector, economists, mainstream economists, they seem to think that the bond market is going to continue to perform like it had since 1981. They don't see the rising yields that we've seen in the last 2 years as a change of yeah, a change into a bear market. And I think that's the whole problem.
Welcome back to Liberty and Finance. We're delighted to have count them, two returning guests today. In addition to Andy Schechtman, the CEO of Miles Franklin Precious Metals, we also have our good friend Mario Ineco, the host of Maneco 64 channel. Gentlemen, thank you for joining us here on Liberty and Finance.
Be here.
Yeah, you're welcome. Thank you for having me.
And Mario, I don't know how long you've been on the stateside to unwind your jet lag, but I have to say that our audience needs to be patient if you're feeling a little tired, because jet lag is a real thing. At least it is for me whenever traveling internationally. So welcome. Great to have you two together. And I should mention that today is Wednesday, January 15th, 2025. Andy's always shocked when I can get the
You got that right. You did that good. If we just had a blooper reel of you trying to get what date it was going back 4 years, it would fill an hour show. And it was
people would have to watch that at double speed, because otherwise they wouldn't believe it.
And no,
Anyway.
sorry for Mario. We already played around the golf at Donald Trump's course, Trump International. We just missed him. He was there, and it took so long to get through security into the clubhouse, and they had opening up trunks, going through cars. We would have got to see him, but he's a trooper. We're very glad to have him staying with us. I'm glad he could be with us today.
It's a privilege for me and for our viewers to have both of you together. We rely on your insights into what's going on, not only in the bullion markets, but in the financial world and geopolitically. We now have both sides of the Atlantic Ocean represented here in this room, so that's awesome. I wanted to talk to you about a principle that's of serious concern. We've been watching and warned by our good friend Alistair McLeod about banking system strains, not only in the U.S., where we saw major bank failures about a year ago. We also have seen in Europe the highest gearing that he's seen in a long time as far as leverage ratios across the banking sector. And unfortunately, a lot of banks carrying on their books what they're claiming to be valuable assets, which are really toxic loans that have no realistic prospects of getting paid off, that are just being dragged along on their books. But also a new article that just came out from John Rubino. We're going to be talking with him about that in the next week or so, but about the strains on the insurance company sector. I know, Andy, you and I had spoken about a few months ago about a principle called pension risk transfer, PRT, where many companies are bailing on their retirees. They're saying, we're not going to hold the bag on your pension anymore. And you could read between the lines, looking at the richly valued markets. We've certainly seen, Warren Buffett building the largest cash position in the history of his company. We've seen insiders selling 6-to-1 at the highest levels of many major companies. So it seems like those who are in the positions to know are bailing on the markets, the equity markets and stock markets. But this was insurance companies who are supposedly the ones who are going to be be the bag holders off of these companies who no longer want to manage their own pension nest eggs, saying that now these insurance companies who are taking these on are showing strains as well. The data and the charts that were included in John Rubino's article that we'll discuss were shocking in terms of the increased risk posture that those insurance companies are facing. So we founded our channel back in 2013 to try to watch over ordinary moms and pops, dads and moms who are trying to take care of their family's finances and try to be responsible. But it's difficult to do so when we're not being told what's really going on in the world of real risk. So that's the first question I want to toss out to you, gentlemen, was what do we know about the strains on insurance companies? Because that is possibly one of the legs in the stool that could get pulled out here and be one of the catalysts that could start a major financial upset and potentially bring down the whole house of cards. I'll throw it out to you and see what your thoughts are on that.
You know, when we talked about the pension transfer, the transfer is transferring the responsibility to insurance companies who now bear the responsibility, because obviously nothing bad can happen to insurance companies. And we started talking about this then, that it's not just the banks that are strained and loaded with assets that have, I guess you could say, become toxic. Assets that were always considered safe and reliable are no longer such, as interest rates are rising again. And the insurance companies and the banks had bet that that wouldn't happen again, but yet it is happening again. The insurance companies are loaded with treasuries. That's how they in their mind are able to guarantee a good portion of their obligations. It's not the only thing they're invested in, but a large portion of what they are invested in would be treasuries, would be things that could certainly have a similar effect in terms of problems in a rising interest rate environment that the banks have. And when we talk about what's happening in California, you know, my heart goes out to all the folks there, and it's hit close to home because one of our own, done again, Megan, my assistant, their family lost their home, completely, totally gone in Palisades. And listening to someone who's actually going through it is heart-wrenching. But this is no small deal. This is, when you talk inflation-adjusted dollars, this is 60% more than the most expensive wildfire in history, at least as of right now. The insurance companies are on the hook for well over $20 billion in damages. And this is exactly the kind of event, the unforeseen event, that can very quickly change the narrative as it pertains to the health of these insurance companies and the health of the reinsurance companies who are backing them up. We're already seeing massive strain on the stock values and the book values of these insurance companies just overnight. Many of the insurance companies saw this coming and bailed. State Farm, I think it was 1,600 policies they did not renew as of July in California because they saw this coming. This is a massive strain that could very, very quickly become something much bigger, as the amount of money that they're going to have to come up with is extraordinary. And this could change not only their books, but the reinsurance books and the banks that they all do business with. This is the kind of event that strains the system. And then they have something, I forgot the name of it. Let me see what the name of it. I think it's called Real. What is the name of it? Give me a second. There is a program that they have in California, especially in this area, that is backed by the government. And I don't know the exact name of it. The point of it is, what I'm really trying to get across is, and it's something like California Real or something along those lines. The commissioner of this program a year ago went in front of the legislature and said that this community pooled insurance program for those folks in high-risk areas like Palisades who couldn't get insurance because of fire risk is woefully under capitalized and has great exposure to risk. This is exactly what she's talking about. So not only are the private insurance companies in big trouble, now you have the government-sponsored programs that are in trouble in a state that is massively underwater. Where does the money come from? And this is a growing problem. God forbid there's another problem that pops up out of nowhere, and then things start to become exponentially more difficult. You have any thoughts on it, Mario?
Well, I mean, I haven't looked that carefully into the insurance situation, but one thing I would say that is more of a bigger picture view is that a lot of people in the financial sector, economists, mainstream economists, they seem to think that the bond market is going to continue to perform like it had since 1981. They don't see the rising yields that we've seen in the last 2 years as a change of a change into a bear market. And I think that's the whole problem for insurance companies, pension funds. They've been used to being able to always refinance at lower rates, and they've had to leverage as well because rates were near zero for so long. So yeah, I think it's a big problem. And We were talking last night, Andy and I, about the 1907 earthquake in San Francisco, how that triggered a big financial disaster back in 1907 that eventually led to the creation of the Federal Reserve. So yeah, these fires in LA, they could be the trigger. Right now, it's still too early to say, but I think we should keep an eye on.
And the people who are thinking rates will never go higher. This is the biggest ever move higher in yields following the first Fed cut ever. And so it's moving counterintuitively to history. It's moving counterintuitively to the Fed's wishes by lowering the front end of the curve. The back end is going up. We were also talking, Mario and I, about what's happening in the UK regarding yields, and he was saying the bond yields on the 10-year, 30-year, what, 5.6, 5.7?
Yeah, almost, and it's at the highest level since 1998.
Right, and so this is not just the United States. This is happening to our allies across the pond. Higher rates is a consequence of all the money creation, of monetary and fiscal irresponsibility, and there's no way around that, which will just add strain to the already over-leveraged, undercapitalized insurance industry and banking industry. And this is something that I think will become a major focus of anyone running a business or trying to figure out the cost of money. It has to move higher on the back end of the curve. And that is the part of the market that all of the loans and the leases and the mortgages and the credit cards, all of the important things are based off of, not the federal funds rate.
I wanted to read a couple paragraphs at the very end of John Rubino's article because he brings it home to what's the consequence on the financial system versus what are our typical political attempts to solve things like this. He says, this raises a point few seem to ponder. The world isn't simply a political structure, yet virtually all the proposed solutions to every problem are political or technological in nature. We can solve this or that politically or with AI. That the private sector can trigger crises that have no political or technological fix is on very few pundits' radar. The problems being exposed do not lend themselves to tidy political or policy fixes that magically return the world to the past era of lower risks. Risks and losses cannot be extinguished. They can only be transferred to others. This is the intrinsic limit of political fixes. We take the risks and losses and transfer them to others lacking the political power to contest the transfer. Or we transfer the risks and losses to the entire system, increasing the potential for a systemic collapse. And that's where I'm very concerned on behalf of all of our viewers and subscribers and their loved ones and neighbors and coworkers and friends, is this idea of that what it seems that the talking heads on the mainstream financial channels don't see coming, although you can't trust it just because they don't say it, they don't see it, is this idea of the potential for black swan event or a stone being pulled out from the bottom of the dam and the whole house of cards, sorry, 3 metaphors there, all coming down. And just I wanted to see if Mario, if we could tap your thoughts on that as far as the risks, what makes this environment that we're now in so different from the environment that prevailed for the past 4 decades that most retail financial planners grew up in, and that they learned their tricks. You know, you guys said you just got back from a round of golf. I heard an old saying. You said, somebody said, I played golf for 20 years. You say, really? Have you played golf for 20 years, or have you played the same year of golf 20 times? In other words, if people are just using the same tricks, the same go-to strategies, but the game has changed, what additional risks are ordinary people being faced with that we have no idea, that they're not being warned about from their mainstream sources?
Yeah, and also the people who have the fiduciary duty to run their investments, they seem to be in the dark about interest rates and how important interest rates are, and the rising yields that we've seen. When the Fed cut rates on September 18th, the 10-year yield was at 3.6. We're now, around 4.8, I think, the last time I saw. So like Andy said, that's going to affect everything, cash flows. And the other thing it's going to affect is the government debt. Government is going to have to issue even more debt to cover all the expenses. That's going to affect the value of the currency. And it's just a huge problem. And the other thing as well, Donegan, is that for 40 years, the bond bull market and the declining yields. We always had lower highs and lower lows. That's reversed. And we got so much debt that was created because of that. And now with the rising yields, the risks increase because rising yields and a lot of debt is a recipe for a lot of crises and disasters.
It's also the recipe for a reset.
Yeah.
Reset the system because it's so indebted, and as rates rise, the ability to maintain that debt becomes much, much, much harder. And that's the point. Since 1982, rates have fallen at a 45-degree angle. Everyone thinks that that's just part of the way things go. Falling rates make asset prices higher, and it's moving in the other direction. And the issue is that it's so many businesses and people in general who are trying to calculate their risk and their ability to maintain and service their debt, expect interest rates to continue to fall, but they're going in the other direction. And that would be the catalyst really to blow up the system. And you put that in context with the way the cycle, the psyche of the investor. Last week, Tuesday, was the record. Tuesday was the record trading day in the United States, all-time record for stocks trading under $1. Those are penny stocks. That is associated with speculative mania. And when you put that together with the Trump euphoria, with everyone thinks that everything is just going to get better, and in some degrees, in some respects, it will. But to ignore the financial implications of where we are, how we got here, and how we get out of here, and what that looks like, writing that off to this exuberance is going to be, in my mind, a massive mistake. And this is the kind of thing that can very quickly change the narrative. And not to mention, I don't know how many people think that if he really is President Trump fighting the deep state, are they just going to lie down and let this go? Or do they attempt to make things very challenging for him within an economy that is so fragile, it just takes but a flick maybe to cascade things down the hill. And I don't want to go into this realm of conspiracy, but for people to think that this will just be smooth sailing, I think is foolhardy.
You gentlemen both watch a number of financial markets fairly closely, including the bullion markets. Andy, if we could start with you and tell us what type of reaction you're seeing in you just mentioned, for example, the action in the penny stocks portion of the stock market and what that usually signifies as far as the frothy beginning of the end. What have we been seeing in the bullion market that tells a different part of the story? Because it seems that those who have the ability to and are able to see past the smokescreen are actually taking actions in a very concerted way.
We've had some very large deals recently, really large, but missing is the volume. It's interesting, Dunnigan, because all we continue to hear is strains within the LBMA and the COMEX. Huge deliveries, 46 million ounces delivered of silver off of COMEX in December. Huge deliveries off the LBMA and all of the exchanges around the globe. The central banks doubling down their 12-month moving average the last 2 months of 2024. And at the same time, I would say that the retail demand is eerily quiet. Premiums on gold and silver coins that were parabolic during the pandemic have fallen to levels I've never seen before. Much like a pendulum shifts from one side too high to the other side too low, that's where we are right now. The biggest, most sophisticated, well-informed money on the planet is doubling down their acquisition of gold. And the people in this country, largely, if I had to, I don't know, kind of just paint a narrative, it would be that they are swept up in the euphoria after 4 years of living in a world that no one really recognized. And I understand it from a basic level. I get it. But I think it's a big mistake, and it's setting people up in disaster. I mean, we can just simply say there are three groups right now, three pools where the majority of the money is. One, money markets, over $7 trillion, which typically is associated with a recession, on top of all of the recession triggers that we've seen, the Somme rule and the uninversion of the yield curve and all of these things. Number two, seven stocks. The Russell 2000 and the Wilshire 5000, which is a much better picture, snapshot of the United States economy. The majority of those are underwater. Seven stocks holding the whole thing up. That's where the majority of the money is. And then in cryptocurrencies. And the cryptocurrency market, in particular, Bitcoin, has been so financialized. Thinking again in terms of a rug pull. One big bank falls, one big bank, like a Bank of America. You keep hearing rumors of it, a bank bail-in. Things get very real, very, very fast, as it would sweep up in one swoop a good portion of all three of these markets: the crypto market, the seven stocks, and the just this money market phase where even though they changed gating legislation, they can now impose serious fines, if you will, or costs for making them really uneconomical to leave the money market if people start to do that. It's the same thing as gating, only you can leave, but at a very high price. So I'm not, again, trying to walk the line of conspiracy and reality, but when you talk about how bad this could get very quickly, it's very fragile. And I think that's the one thing people are missing. It's very, very fragile right now. And I think the stage is set for something to happen that would very quickly wake up the entire country, which would very quickly reignite the demand for physical precious metals, like we saw last March and April when the banks failed, Silicon and Signature, where we added 14,000 clients in 45 days. That's 4 years worth of client acquisition. And those banks were illegally bailed out. Remember what happened in Lindsay, Oklahoma in October, the first bank bail-in. Was that a test flare, if you will? Was that a trial balloon for a bigger, more significant bank failure, which would usher in what? I guess that remains to be seen. But yeah, I think that the people are missing entirely. It's funny because at the same time, all of the people are missing, the most well-informed traders in the world are doubling down. This is the one thing that I think kind of slaps me in the face. And I'll be one of the only people saying this over and over. But yeah, but you own a gold company. I don't care. I mean, the truth of it is, that is what's happening. Biggest money in the world doubling down on gold, not on cryptocurrency, not on money markets, and not on the Magnificent Seven. At the same time, that's exactly where the people in this country are, thinking that rates could never go higher, things can never get worse, we can never see a bank or insurance company failure until we do. Your thoughts?
Yeah, I would add that I don't have to add anything about demand for bullion, but it feels like the sentiment for gold and silver is still
Low.
really low.
It is.
Despite the fact that we had a great year last year. Gold was up like 27%, silver about 21. And
That's not high enough anymore in this instant gratification world.
I've noticed that, like in China, though, the public is the demand for gold and silver is huge. So I also feel that they're a bit more savvy about what's going on, and even the Chinese government, communist government, is encouraging its people to buy gold. And yeah, so I think when the stock market turns, especially the NASDAQ, and I think they will turn, and also cryptos, we could see people ask themselves, where could we go? And they're going to look at gold and silver and the miners as well, and see how undervalued they are. So yeah, in a way, I think that's, we're still, there's no exuberance in the precious metals market yet.
I wanted to tap both of you guys as well, and maybe I'll start with Mario on Andy, you were just using the word fragile to talk about the economic system. I wanted to ask you about the instability culturally across the globe with uncontrolled immigration. We've followed at least about a decade of for almost uncontrolled immigration that has been mysterious to many people, watching culture after culture after culture, where the people that grew up there, their ancestors grew up there and everything, saying, I can hardly recognize my country anymore. Who's pushing this and what is going on? And yet we have in Europe, many different countries there, as well as in the US, uh, more people speaking out and saying, we want our country back. And Mario, I guess if you could comment from the European side of that, how you see this as do you see this as a potentially destabilizing force, just as we've talked about economically, culturally, and do you see any potential financial or economic impacts of that? We've heard that Germany is the engine that's still pulling along the eurozone, et cetera. But can you talk to us about what you're seeing in Europe related to cultural impacts and potentially financial impacts of the legacy of runaway immigration that we've been observing?
Right. Yeah, I mean, it's not just in Europe, like you said, it's also in the US, the whole Western world. And I think it's by design, by the same people who are behind like the climate agenda. And I think the reason they're doing it, and I say this being like born in Brazil and having studied here in the States and living in the UK. I mean, I've moved around, but the kind of immigration they've had, and especially in the last few years, allowing illegals to come in and financing them, it's just the resentment is starting to grow against these people, and I can understand why they want to come to Europe or the U.S. because their countries have been kind of also destabilized. Yeah, it all seems to be culminating. I've always spoken about the symptoms of a dying currency. It's not just economic, but also culturally and societal. And I think the people behind this, like let's say the Open Society, George Soros and others, their goal is to destroy nations so that they can have like a one world system, which is easier to control. But there's a lot of backlash now, and we saw in Romania recently they had elections there, and this candidate who wanted to reverse these policies, he won, and they canceled the election. And now we're going to have elections in Germany, I think February 23rd, and I think Breton, he's like a French politician who was a commissioner in the EU. He said, if the AFD, alternative for Germany, if they win, we're going to cancel that election. I mean, it's
How
good.
can they even say that?
I know it's just pretty outlandish. So yeah, and the other thing, and then again, it's the old concept of divide and rule. So if we all like at each other's neck with illegal immigrants and we're feeling that our culture is being destroyed, people will get angry and they might rise up, and that will give them an excuse to crack down even more. So it's a really difficult situation, and that's why I always tell people that yes, keep an eye on these things and they will affect you and your family greatly, but try to not let it get you down and try to look after yourself. And that's one of the reasons why uh, I tell people about gold and silver, because it's something that it's not going to protect you in all aspects of life, but financially it will keep you relatively safe. And if you have financial safety, you can try to fight what's going on.
Yeah, if these people in positions of power can actually say something as ludicrous as that, well, if they win, we'll decertify the election. What does that say for the mountain that Trump has to climb? And these people are not just Eurocentric. This is a group that is the whole Western centric. And that's why I think that 2025 to me will probably be a more eventful year than any of us think. Probably more eventful than things that we saw over the last several years, which no one would have ever thought anything like that could happen. I think that's kind of, to me, the prevailing environment, Donegan, is that people are not prepared. They think the worst is behind us. And so, the rain is gone, so they shed their umbrella and their rain jacket, and they don't see what's the possibility of it happening again. And I think that to me is the scary part, is that people are now probably doubling down on the risk on trade and not looking at any potential black swans because Trump is here. And I think that is a fatal flaw, perhaps, of the way people are thinking of things.
Andy, in the face of that, we've been trying, and you've been trying on a weekly basis to provide opportunities through lowest prices on bullion and that sort of thing, so people can be, as Gregor Manarino says, become their own central bank. We'll be interviewing him later this morning, and wanted to see what you've got for people. I believe it's a repeat this week of many of the specials that we announced last week.
It is, to me, the best, and I don't even know exactly what we have, but the junk silver to me is the best buy, period. And until we sell out of it, I think if people are looking for silver, the pre-65 silver, there is nothing of better value. And as I mentioned to you last week, today's Wednesday. Today we get in our vault a very, very, very large shipment of pre-1933 coins that we bought. I can't even believe that we bought what we bought. I'll put it to you that way. I don't know if I've ever overcommitted myself the way that I did on this one. And I think it will be the best special that we've ever offered, ever in the history of my company. That's a big statement next week. So for this week, it is the same. Whatever you're buying right now, things are on sale, period. I suppose you know what the specials are. Done again, I don't. But
yeah, I can run through them. We've got the 1 ounce Canadian silver Falcon coin at $2.75 over spot.
So the silver Falcon coin is the Canadian Mint came up maybe 2010 with the Call of the Wild series, and then mitigated to the Birds of Prey. And these are, first of all, they're the purest silver coins in the world at 4.9 fine, and they're limited mintage of only 1 million each. Sounds like a lot, but I don't know how many tens of millions that the Canadian Mint will make for regular Maple Leafs. They are very highly sought after. They're limited mintage. And at the price that we're selling, and that is probably the cheapest sovereign coin that we're selling, it's a hell of a deal. It truly is. And I own all of the Birds of Prey. I own all of the Call of Wild. I bought a mint box of each along the way. So I think they're fantastic to hold. And you know, they're one of these deals that, who knows, maybe they do have collector potential somewhere down the road. That's not why we sell them, and we're selling them cheaper than any of the sovereign coins. These are, if memory serves, maybe 2014.
Yep, they are.
I think, yeah. So they, you know, these are a decade old in sealed boxes or sealed tubes, and they're awesome. I like them a lot. The gold Maple Leafs that we have on sale, you know, that's a boring thing to me. It's boring, but they're cheaper than gold bars. They're cheaper than Costco is selling gold bars for. They're cheaper than we're selling gold bars for. That's something I've never seen. So
That's from 59 over spot for the 1 ounce Canadian gold.
$59 over spot. You're talking real damn close to dealer cost. So I like them a lot also. And what was the third one?
Well, we have the 10th ounce gold Britannias at $29.99 over melt.
We did that specifically because he was here. You know, because Mario, the 10th ounce gold Britannias, again, trading, utility.
Yeah, the premiums in England as well, in the UK, are really low right now.
Yeah.
So.
No, and you know, I think you can never be too flexible. You can never have too much liquidity, utility. But again, I'll say, period, to my mind, the best value of anything we're selling right now is the pre-65 silver. It is. And
that's $1.69 over spot per ounce. Yeah.
Yeah. And, you know, that was higher than anything but the Silver Eagles for 4 straight years. So during the pandemic. So I would simply say, whatever you're buying, it's as good a premium as I've seen in 35 years. And we're just one event away from that changing. I know that sounds repetitive and silly, but does anyone really think that it's going to be smooth sailing? I don't. And maybe something like that jars the American public into realizing that gold and silver should be part, even in the best of times, of your portfolio, as the folks at Ibbotson have shown us on their analysis of portfolios with or without precious metals. And the Swiss bankers that I learned from my first 3 years in the business, spending summers in Zurich learning Swiss investments, that was the that was our business when we started in 1989. That even in the best of times, a 10% allocation to gold is critical for all Swiss bankers. Everyone told me the same thing. You can't be, you must have a little bit of gold in your portfolio, even in when times are fantastic. And so I don't know. Yeah, I think there will be a reawakening, and things that are massively undervalued as the pendulum shifted too far this way will benefit from that. And junk silver is one of them.
I just wanted to pick up on what you just said, the Ibbotson study. Folks, if you haven't already taken a look at the Ibbotson study, it was an independent study done by Ibbotson and Associates comparing model portfolios over periods of time to see what would be the ideal percentage of physical gold in a portfolio that would protect the rest of the portfolio over market upsets, etc. We'll be happy to send you a link to that study if you just email us at libertyandfinance@protonmail.com. That's libertyandfinance, all one word, @protonmail.com, and just put the word study in the title of your email, and we'll get you a copy of the Ibbotson study so you can pour over it. It's very interesting. It shows the breakdown of the Dow 30 stocks by their various risk and reward positions on a scatter chart, as well as how model portfolios performed, and then a calculated percentage of optimal amount of gold in a portfolio. And I'll give you a clue, it's not 0%. So unfortunately, 99.5% of the people in the country obviously haven't read that study, or they wouldn't be doing what they're doing, or failing to do what they should be doing. We wanted to thank both of you gentlemen for being here. You've been generous with your time. I know you've got agendas. You got to go golfing with Trump and everything. I understand that people have to do what they have to do. But for those of us who are back here at the Liberty and Finance channel, just thank you for joining us on behalf of all of our viewers and subscribers. We couldn't do it without them. We couldn't do it without guests such as yourselves taking the time to share your insights with us, and we're grateful for you being here. Thank you both.
To be here, Doug, again. I hope you have a good one. And unfortunately, I won't be here next week as I am heading up to the Vancouver Resource Investment Conference. And again, a shout out to Jay Martin and his fantastic show. We'll be back, pick back up with you 2 weeks from now. But wish you and everyone else a good afternoon, and look forward to chatting with you again real soon.
Thank you, Andy. Andy Scheckman, the CEO of Miles Franklin Precious Metals, and Mario Ineko, the founder of Monaco 64 channel. Thanks for joining us on Liberty and Finance.